low yielding stocks. These are some of the favorite stocks inside of my portfolio today, but they are also some options that particularly investors that are looking to grow a passive income stream often avoid. These are typically stocks that yield in the 0.5 to 1.5, 2% range, and they often get overlooked because people simply focus on the passive income. But I'm telling you right now that you actually might be costing yourself a larger passive income stream by not looking into these stocks. I'm going to go over a quick preview of a case study we did over at Premium when we backtested a portfolio of some of the strongest low-yielding companies in the country and pit them against some of the most popular Canadian dividend stocks. And then I'm also going to go over two outstanding low-yield options that I think you should have a look at today, especially considering the potential recession we could be heading into in 2023. So let's get right into the video. So before we get started talking on the two low dividend yield, high dividend growth stocks that I absolutely love and want to talk about in this video, if you've been a reader or a watcher of this channel for very long, you will know that I absolutely love low yielding, high growth stocks. They make up the vast majority of the income portion of my portfolio and the vast majority of my portfolio altogether. So many people were asking me why I like these types of stocks, and especially our premium members. So we decided to run a backtest case study against some of the best low yielding, high dividend growth companies here in Canada, and we wanted to pit them against some of the most popular high-yielding income options here in Canada that the vast majority of Canadians have inside of their portfolio. So what did we do? We made up two model portfolios, each of which contain an equal weighting of 8 stocks. So the low-yielding portfolio contained all of these options, and the high-yielding portfolio contained all of these options. So you're going to see companies like Alimentation, Couche-Tard. You're going to see Brookfield Asset Management, Canadian National Railway, Loblaw, TFI International, Waste Connections. These are not small cap companies. These are not penny stocks. These are legitimate companies with sizable economic moats, and we compared them against some of the most popular Canadian dividend stocks around, stocks that I see investors holding all the time. Bank of Nova Scotia, BCE, Power Corp, Sun Life Financial, Manulife Financial. Not to say that these companies are bad, but I really wanted to highlight how this low-yielding portfolio has fared against the high-yielding portfolio. So I don't want to go too in-depth on this backtest study. There is a 14-day free trial to Premium if you actually want to see the results of this. Absolutely free trial to Stocktrades Premium. I'll put a link down in the description. And if you head to our Premium content section, you are going to see this entire case study. And this is the kind of stuff that we deliver to people on a weekly basis in our newsletter. But anyways, let's get to the two stocks that I wanted to talk about in this video. And the first one is actually Alimentation Couche-Tard. They just recently reported earnings, so I want to go over the earnings report a bit and actually dig into the fundamentals of the company and why I think this is one of the best stocks to own in Canada. So first off, what does Couche-Tard do and why do I absolutely love this company? Well, for one, it has a bare bones, very simple business model. This is a convenience store operator. So they operate convenience stores in North America, Ireland, Scandinavia, Poland, the Baltics, Russia, and the company primarily generates income through the sale of fuel, but it also sells things like tobacco products, groceries, beverages, fresh food. They have quick service restaurants. They offer car washes, chemicals for your vehicle, motor oil, things like that. And for the most part, the brand you are going to see Alimentation Couche-Tard operate in is Circle K. Back in the day, they, at least in Alberta here, they used to have a lot of Max stores, they called them, but they have transitioned most of those to Circle K, and that is by far their biggest brand. Now, why has this company been able to grow at such a rapid clip? Well, this industry is highly fragmented, and as a result, Couche-Tard is essentially able to buy up convenience stores and kind of, tuck them into its more than 14,000 locations right now. They essentially almost instantly drive revenue and earnings growth for the company. And when you look at a 10-year chart here, This is about as silky smooth as a 10-year chart gets. We've maybe had, a few years in 2015 and 2016 where it's been flat, but for the most part, this company has shown a history of long-term double-digit annualized returns. And when we actually go to the 10-year returns of Couche-Tard, if we were to reinvest the dividends, if I go total return, we can see that this company has returned 700% in the last 10 years. On an annualized basis, this is 23.19%. You won't get this from the S&P 500. You won't get this from the NASDAQ. I don't even know if you would get this from a company like Google or Amazon or Apple. In fact, we can actually look up those annualized returns and compare them to Couche-Tard. So I did have to remove Google because it didn't have a 10-year history. But when we look to Amazon and Apple, we can see that this company has kept up in terms of annualized returns with some of the hottest tech stocks in the United States. And this is a company that sells cigarettes and gasoline, essentially. Now, how has it been able to do this? Well, it's primarily through strong earnings growth and strong revenue growth. If we look at the company's revenue on an annual basis, its earnings on an annual basis, and let's take a look at its dividend. When we look to the last 10 years, Alimentation Couche-Tard has grown revenue by 120%, earnings by 517%, and the dividend by over 1,000%, a tenfold increase to that dividend. And the only way it can grow that dividend is through this strong earnings growth. There's no other way. And it's really not slowing down. When we minimize this to a 3-year period, the COVID-19 pandemic did have short-term impacts on the company, so revenue and earnings growth don't look that good on a 3-year basis, but we can still see that this company has doubled, 124% increase to its dividend over the last 3 years. And when we go to a 5-year period, we can really start to see that earnings growth is coming back post-pandemic and existed pre-pandemic as well. There was just a short-term blip where this company was starting to struggle. So before we get into the recent quarter, I do just want to look at the overall financial health of the company to show you how strong of a position Couche-Tard is moving forward. When we look to the returns on invested capital, 15% returns on invested capital, and this is a company that has consistently put up double-digit returns on invested capital for the last decade. In fact, it's done so, since the early 2000s. It started really excelling in the late 2000s and especially post-financial crisis. But when you have a company that can consistently put up double-digit ROICs, this is definitely something that is going to compound your wealth internally. That is for certain. And return on equity is strong as well, 22.29%, and it has maintained this strong return on equity as well over the last 10 years and even into the early 2000s. So these are two very strong signs that this company knows how to be profitable and knows how to generate strong shareholder returns. So the company does have $7.5 billion in long-term debt, but considering it has a market cap of $61 billion and generates revenue, trailing 12-month revenue of $87 billion, this really isn't that big of an issue. And when we head down to the debt ratios, we can see that it has a debt to equity of 0.47, very healthy. It has a current ratio of 1.26, very healthy balance sheet. It has 13 times interest coverage ratio, showing that this company generates more than enough to satisfy the interest payments on its debt. And if we scroll back up to the dividend, this company only yields 0.93%. And this is one of the reasons why many income investors, particularly those who are kind of obsessed with high yielding stocks, they miss out on Couche-Tard because they don't like this yield. But the only reason that this yield is so low, especially considering the fact that Couche-Tard has, as I mentioned, grown the dividend by over 1,000% over the last 10 years, the only reason you grow the dividend by 1,000% and you still have a dividend yield like this is if the share price is appreciating just as fast as the dividend. And as I showed you in the chart, it has been. This is a dividend that is low yielding but fast growing. And there may come a day where Couche-Tard does show slowing signs of growth, and at that point that dividend might rise. Realistically, as shareholders, we never really want this to happen. The company has generated outstanding returns internally without even needing to pay out a dividend, but there is a possibility down the line that Couche-Tard's yield does raise a bit as it gets into the more mature stages of its business, but I don't expect this anytime soon. If you're thinking that Couche-Tard will one day, in the near future yield 3-4%, I really don't think that's going to happen, but you're getting this as a combination of both earnings growth and dividend growth. We can see that trailing 12-month cash flow sits at nearly $5 billion. And if we want to see from a free cash flow yield perspective what this company is generating, we can go to the charting here and we can go free cash flow yield. And we can see that this company has a free cash flow yield of 7.63%. This is pretty solid. It's actually quite outstanding for a company to have this type of free cash flow yield. So we know the company is solid historically, but how has it performed in 2022? And it has performed outstanding, to be honest. It's outperforming the NASDAQ by over 42%. This company is one that has been able to provide strong growth, even though the market and the economy are in a significant bear market right now. It has performed outstanding, primarily because this is a consumer discretionary stock, but really this is a consumer staple. People need fuel. They're always going to buy cigarettes. They're always going to buy scratch tickets, things like that. When they head into the gas station, they fill up with their fuel. They're going to buy a Gatorade. They're going to buy a chocolate bar, whatever it means. This company tends to generate strong revenue and strong earnings growth no matter what the economic circumstances. And when we look to its recent earnings report, it has continued to do just that in 2022. The most recent earnings report from Couche-Tard, it did miss on top and bottom lines, but it also increased the dividend by 27%. So although it missed estimates, the stock didn't really move that much on earnings because it was still a relatively solid quarter. So we can see adjusted diluted net earnings per share were 82 cents. This is an increase of 26.2% compared to last year. Now, this is a relatively strong gain in earnings because last year, we were in not full-blown shutdown mode in late 2021, but we were definitely still witnessing some of the impacts from the pandemic. We see merchandise and service revenues of $4.1 billion, small increase, small single-digit increase, pretty much across the board. Margins are increasing, which is nice to see, even though it's only 20 basis points, 0.2%, a little bit stronger in Canada, nearly 1% increase in gross margin. So when we look to acquisitions, remember how I stated that the industry was highly fragmented? We can clearly see this. It completed the acquisition of 218 more sites, consisting of 79 company-owned convenience store and fuel locations, 2 company-owned dealer-operated locations, and 137 dealer-owned and operated locations, and a fuel terminal in Atlantic Canada. So every single quarter, this company is consistently picking up new stations and new distribution networks. So another big benefit as well with Couche-Tard is not only is it increasing the dividend by a rapid amount, it's also buying back shares at a crazy pace. So during the second quarter, they purchased $205.2 million, and through the first half of fiscal 2023, they purchased $683 million. So this company is purchasing back a ton of shares. So as mentioned before, strong returns on invested capital and a 27% increase to the dividend. Overall, although it missed on estimates, this is still a very strong quarter from Couche-Tard, and it really didn't dip that much on the miss. So the next stock I want to go over, and one that I feel might be very key if we head into a recession in 2023 and possibly 2024, and that is Loblaws. So Loblaws trades under the ticker L.TO on the TSX, and this is Canada's biggest grocer. Every single person in Canada on average is less than 9 kilometers away, I believe, from a Loblaws, and this grocery store giant has just been performing outstanding the last few years. So this was a foundational stock over at Stocktrades Premium in 2018 and 2019. We essentially stressed how deeply discounted this company was relative to the cash flow it was generating and how cheap it was on an earnings basis. And as we can see in the last few years, especially post-pandemic, it has shot up in price, and I would say that valuation gap has certainly closed. But just because the valuation gap is closed doesn't mean you shouldn't look at this company as a very strong option, especially a blue chip option defensive option heading into the environment we might be going in. Say we look to another grocer like Empire, or even the Northwest Company, and we look to Loblaw. Loblaw has the largest discount factor out of any major grocer here in Canada. So when we look to Empire, it operates Sobeys stores. So that's their main grocery store, whereas Loblaw has stores like No Frills, Loblaw stores, No Frills, Maxi, Shoppers Drug Mart. So the number one thing with No Frills is it is one of the largest discount stores and one of the cheapest grocery stores around. So if people are looking to pinch pennies and if people are looking to save money, they're certainly not going to shop at a place like Sobeys over a place like No Frills. It's cheaper. You could argue that the goods aren't as high of quality, but the reality is when people start to pinch pennies, they tend to head to discount shops like Dollarama, and they tend to head to discount grocers like No Frills. So in my opinion, Loblaw has the largest discount factor out of all major grocers, and I really think that's why it has been able to generate strong growth over the last few years and why it probably will be the best performing grocer moving forward. Now, in terms of price gouging, I know I'm going to get comments on that. I did some very deep digging. There has been no price gouging from Loblaw's in terms of grocers. It has generated a significant amount of extra profits over the last year, yes, but it doesn't take very long. You just need to dig into the financial reports to understand that most of the increase in earnings from Loblaw over the last year has been a result of debt reduction in combination with lower interest rates causing less interest expenses, and it has also come from the growth of its Shoppers Drug Mart segment. So much like Couche-Tard, we're seeing double-digit returns on invested capital here, and Loblaw's, again, has been a relatively consistent performer. It has had a few down years, and actually 2 or 3 down years over the last 20, but generally over the last while, this company has been improving its returns on invested capital, particularly from the high single-digit range to the double-digit range. And when we head back to return on equity, we can see near 20% returns on equity, and much the same as returns on invested capital. It's had a few down years, but it generally provides double-digit returns on equity and has over a very long time period. Now, if we go down to the dividend, this is again a company that does not yield very much. It only yields 1.38%, but it has a very long dividend growth streak, and the payout ratio in terms of earnings is only at 24%, which means you are highly, highly likely to get very strong dividend growth moving forward. And when we look to the balance sheet and to debt levels, debt to equity of 0.74, not crazy high, but a little high on the higher side, but with a current ratio of 1.34 and an interest coverage ratio of 7, sound balance sheet, plenty of cash to pay interest on their debts. Debt burden wise, this company is in no trouble at all. So in terms of overall growth with Loblaw, let's look at the dividend, let's look at revenue, and let's look at earnings. You can see that over the last 10 years, they've grown revenue around 68%. They've grown earnings around 144%, and the dividend has grown by about 84%. So this isn't as strong of a growth option as Couche-Tard, but this is also a much more defensive option than Couche-Tard, and one that could do well in the environment we're going to head into. When we look to free cash flow yield, we can see that the company actually has a better free cash flow yield than Couche-Tard at 15.79%. This is very, very strong, and Loblaw's does generate a significant amount of free cash flow. Its margins are very low. These grocers typically operate profit margins in the 3 to 4%. It's relatively low. We can see here profit margin, 5-year median profit margin is 2.4%. We're looking at low single digit. These companies rely on volume. They sell a ton of volume, and they make very little off every sale they make. So you're not going to see the flashy high double-digit profit margins, but overall, the company is very good at generating free cash flow. Now, when we look to estimates, this company is expected to grow earnings at looks to be a mid-single digit pace, and revenue by low to mid single digit pace. This is not a company that's going to blow you away with high growth, but it is one that at 16 times trailing earnings, and I believe it is trading at a low double digit price to free cash flow. Yeah, at around 11.8 times free cash flow. This is a company that does not cost you very much to own. It's trading at a very respectable valuation, and it should be able to be the best grocer moving forward. So everybody, that's it for the video. I really hope you liked it. Again, don't be avoiding these low yielding stocks because you're hyper focused on growing a passive income stream. The underlying share appreciation from these companies can eventually lead to you transitioning them into a potentially higher yielding investment that could end up paying you more passive income. The snowball effect that a lot of people want from getting paid dividends and then reinvesting those dividends, often that snowball can grow better by investing in strong compounding companies with strong returns on capital. Alimentation, Couche-Tard, and Loblaws are two companies I feel are excellent options right now, especially considering the environment we could be heading into in 2022. Again, if you want to grab the full case study on the back test that we did from the low yielding options compared to the high yielding options, which is actually, it's a pretty crazy study we did, and the results even shocked me. You can grab a 14-day free trial to Premium, no credit card required, completely free, no obligation. It's in the description below. Like the video, subscribe to the channel, comment down below. More likes, subscribes, comments means more free content we can provide on the channel, and we'll see you next time.